Hello everyone, welcome to our webinar and I hope you're keeping well in these challenging times. I'm Matt Adams, Head of UK Asset Manager and Asset Owner Client Line here at BNP Paribas Securities Services, and it's my pleasure to be kicking off today's event. Normally at this time of year we host a half-day fund management conference in London, but that is of course not possible. So we've put together this virtual event to discuss some important issues around the UK funds industry. This webinar is going to be in two parts. In the first part, we'll be discussing the future of the UK funds regime with experts from across the industry. Then in the second part, my colleague Nick Jenkins will provide an update on UK funds and regulatory issues. If you'd like to ask a question at any point, please do click on the Q&A button at the bottom right of this screen. So on to the first part, which is called The Keys to the Kingdom, the UK's funds regime in a post-Brexit world. Firstly, I'd like to set the scene a little. Some of you watching might be wondering why BNP Paribas, the leading French bank, is focusing on this important UK issue. As you can see on this slide, we've actually been in the UK since 1867, making us one of the oldest custodians, and we have offices in London and Scotland supporting more than 50 clients here and abroad. So, like all financial institutions, we are now counting down to the end of the Brexit transition period, which will be on the 31st of December this year. With only weeks to go, we now find ourselves approaching an extremely significant crossroads in what has been a truly complex and at times confusing process. Today, we will focus on the opportunities and challenges facing the UK funds market going forward, and what, if anything, may need to change in order to capitalise on any such opportunities affecting cross-border investment and to defend domestic preferences once the transition period ends. It is at this point that the UK will have the ability to diverge from the existing UCITS framework, which currently regulates the majority of UK retail funds. Now, most professionals agree that the existing UCITS framework is very much a European success story, and still, in many ways, the envy of other regional attempts for a harmonised cross-border framework. I've actually seen this firsthand while working through the early developments in the Asia Regional Funds Passport and ASEAN Collective Investment Scheme framework. If we take a look at some statistics in this next slide, we can see that the numbers back this up. For the leading fund domiciles of Ireland and Luxembourg, the UK features strongly as a destination for registrations and therefore investor interest. For Ireland, the UK is the number one destination with nearly 3,300 registrations as at the end of 2018. In Luxembourg, the UK ranks fifth behind only Germany, Switzerland, France and Austria, which is no mean feat in itself. So we know the UK is an important cross-border destination within the EU, but how do UK funds currently fare overseas? Actually not too well, according to statistics by the Investment Association. On this next slide, you can see that despite UK domiciled funds increasing their AUM by over 70% between 2012 and 2019, the percentage held by overseas investors has remained very low. In fact, falling over the same time frame from around 4.5% to around 3.8%. The UK is very much a dominant player in fund management, but it is not as dominant as a fund domicile. In terms of UCITS funds, the UK ranks below Ireland, Luxembourg, Germany and France in terms of number of funds, and the gap widens still when we include alternative investment funds. As we know, prior to the UK leaving the EU, the UK established a temporary permissions regime. This allows eligible EU UCITS, which have notified the FCA to continue to market in the UK in a very similar way for a limited time period after the end of the transition period. For the fund to continue to be recognised in the UK after the end of the TPR, it must apply for recognition under Section 272 of the Financial Services and Markets Act. The assessment process under Section 272 is widely regarded as being quite time-consuming. It is expected that a large percentage of the 8,000 funds, which includes money market funds, which had notified the FCA by the end of January 2020, will subsequently apply for recognition under Section 272. This would obviously pose a huge operational challenge for both the FCA and the asset management industry. In addition to these obvious operational challenges, some concern has been raised in the past as to whether the existing regime is both proportionate and viable in the longer term. As a result, Her Majesty's Treasury has decided to streamline the recognition process and create a more streamlined overseas funds regime, as this next slide demonstrates. We saw a consultation paper published by Her Majesty's Treasury on the 11th of March outlining details of the overseas funds regime. In this slide, you can see the process that the UK government has set out. The proposed regime is designed to simplify the process for overseas funds to be marketed to UK investors. The proposal is outcomes-based and open-ended, which has been largely welcomed, and the consultation asked a number of questions, namely around the governance of equivalence. On the 21st of October, the OFR proposal was included in a new financial services bill introduced to Parliament. But what about fundamental change? It seemed that many asset managers were initially in favour of the UK staying in line with EU regulation in the post-Brexit environment. However, there is growing sentiment that perhaps a new regulatory framework could be created using the existing UCITS rulebook as a strong starting point, and then building in some additional simplification. This could present a competitive funds regime that could be marketed to countries where the UK is able to secure new trade deals outside of the EU framework. Asia is an obvious choice here, given the existing similarities to legal structures such as in Singapore, or the links to China that exist via Hong Kong, and of course Japan, being largely domestically focused until now. But the US, Canada, and other English-speaking countries are all key markets that could be considered too. With all of these factors, there have been several suggestions for improved UK fund structures, such as the Long-Term Asset Fund, or LTAF, proposed by the Investment Association, which looks specifically at improving the redemption mechanisms that have caused issues for funds investing in illiquid assets. My colleague Nick Jenkins will be talking about this in more detail in part 2 of today's webinar. And we should not forget some of the bigger trends impacting the industry right now, not least the growing demand around ESG investing and the opportunities created by technology, which may pave the way for more simplification of cross-border governance and, of course, distribution. So, to discuss these questions further, I will now be joined by industry experts Julie Patterson from KPMG and Nick Wright from SS&C Technologies. Nick, perhaps we could start with you by introducing yourself.
Hello, my name is Nick Wright. I work for SS&C and I head up our global investor and distribution solutions, which provides transfer agency and other services around the globe.
Thank you, Nick. And Julie?
Hello, everyone. Julie Patterson at KPMG. I work in our European Risk and Regulatory Insights Centre. I lead on regulatory change for our sector at large, any sorts of assets or any types of funds or any types of clients, really. And basically it's watching what's coming down the track in terms of the regulatory debates and how the conclusions of that could impact the sector.
Great, thank you very much. And thank you both again for taking the time to join us today for the webinar. So I think if we kick off and we stay on the theme of, opportunity or threat, and perhaps look at what the UK asset management industry needs to do to remain competitive in both the domestic market and, of course, the cross-border space as well. And looking at whether a departure from those existing UCITS rules is a good idea or not. Nick, let's go to you first, please, for that one.
Yeah, I think the obvious answer, which I think we'd all agree to, is it a threat or an opportunity? The answer's both. Right? There's undoubtedly threats, there's undoubtedly opportunities with it. I think we're also operating within the double whammy. I think we were all nervous about Brexit. We didn't realise at the time of Brexit we'd likely be going through a global pandemic at the same time. But I think in some ways that provides an interesting dynamic, because London's always been held up as the base of the European asset management community, and people being in the office. But of course, none of us are in the office right now, or very few of us are in the office. And we're certainly seeing people who were working from the UK can now work from wherever. So I think that changes the dynamic. I think we've obviously got the open question as, will there be an agreement or not be an agreement? I think we'll all probably have different views on that. My sense is probably late on the 31st of December, an agreement will be struck and we'll move forward. But undoubtedly, there is going to be pressure coming from ESMA and the European Union to shift some of the balance of power. I think equally there are big opportunities for the UK within it. We'll come on as we go through this. There are large numbers of UK investors who continue, and I think even post this, will continue to invest in UCITS products or various offshore products. Equally, there's opportunities for the UK to develop broader fund ranges and regulations that will allow more local things. So, and then of course the challenge for all of us as providers is actually, we're relatively agnostic. Whether it's BNP or SS&C, if somebody invests in a UK fund or a Luxembourg fund or an Irish fund, we don't really care that much. We've got the capabilities that we service them wherever they are. So both is the long-winded answer to your question.
Yeah. And in terms of that departure from the existing UCITS rules, do you have a sort of a feel for your own opinion, or a feel for where the industry will go there? Will they stick to it very closely, or will we see a departure for them, certainly in simplification, for example?
Look, my sense is that people will broadly stick to it, because I think consistency is probably more important than anything else in terms of how you do this. I do think there's an opportunity for the UK, and frankly the government and us as an industry have a choice as to do we want the UK to be the place of light touch regulation. I'm not sure any of us, whilst it may create some short-term opportunities, would see that as necessarily the way to go. And my personal view is that's the answer. And I think the world, we have popularism everywhere, which is probably encouraging people to pull down the boundaries, but the overwhelming power is globalization, I would have thought, and that requires global simplification, not the other way.
Understood. Yeah, thank you. And Julie, your views on that, please.
Yeah, sure. In fact, let me start at that end of the question, the UCITS question, because it's an interesting one. One of the issues we've got to think about is not only the UK audience for them, but the international audience. And as it is, we will not be able to call them UCITS, because UCITS are by definition EU domiciled funds with EU domicile management companies. So we'll have to have something like the UK version of UCITS. So, if we're serious about exporting, we've got to explain that to the, other countries, other jurisdictions. So trying to explain that term and at the same time making fundamental changes to the underlying substance of the brand would seem to me to be a very difficult ask. So I'm not sure that's the best place to go. And I think, I'm not everyone, but there has been the odd commentary, it would be good for the UK to be able to move away from UCITS rules. And when you delve into that a bit and you ask that commentator what do they mean, I've had some very interesting and odd discussions, such that one person was solely talking about the PRIP kit. not actually the UCITS. They were only talking about the difficulties with the current disclosure. Do you see what I mean? So when one digs into it, I'm not sure that's a sensible place. And in any case, in the UK, we have the non-UCITS retail schemes, which is the place that allows us to do other things. So we have that. But maybe then back to the first part of your question, I think, like Nick, it's multifaceted. And I would actually add some more dimensions to it, because I think you would get a slightly different answer if you're talking about UK retail investors than if you're talking about UK high net worth or you're talking about UK institutional investors. Because generally speaking, UK retail investors have always gone for UK products. High net worth have been more happy to use a mix of UK and offshore, whatever that may be. Maybe Luxembourg, Ireland, or maybe it's Bermuda or whatever. But also the institutions similarly have taken a mixed approach, depending on their own, how cautious they are as an investor type. So I don't think there's one answer that, when you think about it from the investor point of view, and I don't think there's one answer in terms of the industry itself, because UK authorised funds, heavily regulated, are very different to the alternative space, and is very different again to the asset management, if you like, portfolio management space. And we don't really know what's going to happen in that last piece, because clearly the UK is second only to the US as a global asset management hub. What will happen? We don't know. Clearly the EU needs actually to generate its own hub in some sense. Will that be? We don't know. But the world isn't just the UK, the US and Europe. There's other parts of the globe that are growing rather rapidly that could themselves become the second or even the first investing hub in 5-10 years' time. So I just think it's more about being agile. Is what we need to do.
Yeah, I mean, I tend to agree, Jill. It's a very complex area, and I think it can be a catalyst for positive change, but a divergence too much away from what we know works would probably be a bit foolish in my opinion. But there's a whole big wide world out there with other developing areas that I very much see as an opportunity. So. Let's focus on some of the existing proposals that we see, including the LTAF from the Investment Association's plans, and also the onshore unauthorised funds regime. How do they stack up, and how are they addressing the right things in your opinion? And we'll stick with you, Julie, to start with.
Thank you, Nick. Well, I was actually on the IA and still am on that working group. So I think, first of all, just to set the context, when the group discussed these points, it was absolutely clear that the UK already has a lot going for it. One of the big issues is we don't promote ourselves very well, or rather we do not promote ourselves as well as some other European countries do. So I think, marketing is something we could learn to do better, whatever we have. We have a lot going in terms of our UK double tax treaty network and so on and so forth. And as Nick made the point, the good regulation is very important. So there were, in the IA proposals, there were 3 options, one of which is around retail provision, which is very kind of UK-centric point. The other two, as you say, is the LTAF and the onshore professional fund regime, which, by the way, is shared with other contributors, such as the AIMA, the Alternative Investment Management Association, has been discussing similar proposals, and some others. So just to say, I think it's quite a wide industry grouping that's been looking at this. The LTAF is very specific. And one of the things, linking back to the marketing point, it would be good, wouldn't it, if we could come up with better acronyms. I mean, LTAF is not something that naturally sings when you're trying to market it. So let's hope they can have a better acronym. But literally at the moment, it stands for long-term assets. Now, you could say security is a long-term asset, actually. So I think what we actually mean is sort of infrastructure financing and so on. And as I understand it, really, the focus now at the moment is really much on making the existing qualified investor scheme in the authorised fund space work better for such assets. And in particular, to allow insurance companies to have it as what is called a permitted link. Is part of regulation. Mm-hmm. So that's there. And interestingly, though, the LTAF was mentioned by the Chancellor himself on the 9th of November in his speech. It was specifically mentioned as something he wants to get going. So that's one particular area, and that is about a specific asset class, yeah? Whereas the onshore professional fund, which again has an unfortunate acronym at the moment, PIF, Professional Investment Fund, which is kind of not a PIF either, really, so we have to think of something better there. But that is more about the investor base. So the idea of it is actually one should be able to have an unauthorised vehicle for professional investors only, which could be open-ended or closed-ended, could be listed if they want to do, but may probably not. Then clearly the management company is authorised, but not the vehicle, yeah? And that the vehicle should actually be able to access any sorts of assets and do that in a tax-neutral way. And so that's the point. So there is a bit of an intersection between the two. A bit of a Venn diagram, if you like, but they're coming at it from different places. And the offshore funds proposal, which again, definitely there's work going on. We're expecting a consultation out from the Treasury on some of the detail of that for people to comment on. But it is very much about saying, why is it that so many fund structures are effectively managed in the UK, but the structure is domiciled somewhere else? You know, this it just seems a nonsense. You know, we lost it a long time ago. Why? You know, let's just try. And it's not so much about bringing funds that already exist onshore, because we all know that's a major cost. You know, you can't just simply shift a fund like you would shift a suitcase or something. It doesn't work. But it is about saying, if we're going to set up a new fund, that management companies should have a genuine option of saying, actually, we could set up this new fund here in the UK rather than having to go elsewhere. So let me just stop there, because that's the kind of the context of what's going on.
Yeah, absolutely. Your views on that, and I guess this would impact some of the service areas, obviously, that you guys are doing as well with your investor base.
Yeah, I mean, where do you start? You could talk for about an hour on this topic, and I think Julie's actually called out a couple of really good points. Look, one is, it's all so complicated, right? And I think whether it's the acronyms or anything else, we have an incredible ability to overcomplicate. So I'm sure I look at the latter from one perspective and think, I don't understand really how it's any different to an investment trust. So I'm not sure how people are people really looking end to end, or are they just looking at a particular segment? And then on the other hand, I'm thinking it's not looking broadly enough. To me, an obvious area of where the UK should be developing some fund structures is around liquidity products. We've got, you know, loads of people investing, treasurers who are investing liquidity out of the UK into a Luxembourg fund or an Irish fund. And the fact that the UK industry doesn't really have a competitive liquidity product. So to me, it's, you know, I think we need to go back to first bases and first principles. Think about, what does that end investor want? You know, and again, I think back to, you know, years and years ago when we had unit trusts with dual pricing and everyone thought, oh, it's way too complicated. Let's create the OIC. And, you know, it was another ridiculous acronym, and then the OIC became this complex, and we in effect had dual pricing all along. So I think as an industry, we've just got to do a much, much better job. And, you know, I think the Treasury, the IA, TISA, others need to come together and work as one. I think that we're just not joined up. And when you cut to Julie's point around other countries market themselves better, well, yeah, they do. Luxembourg market themselves better because it's clear Alfie do that role and they do it very well. Where's the Alfie or the IFIA equivalent in the UK? And, you know, I'm just not sure I see people playing that role. And, you know,
yeah,
the same that, you know, to a degree, the service providers aren't even really part of the IA. Well, we're missing out on an opportunity in terms of how we do that. So lots of different points.
Absolutely agree. And I think one area that we're majoring on here and keeps coming up is simplification. As the industry made it complex for complex sake, sort of take a back step. And across many areas of the financial industry, I think technology is something that could be leveraged better to help us with that. So let's move on to that sort of theme and how managers might be able to leverage technology better to remain competitive, regardless of the structures and the platforms. But we're dealing with what is a fragmented European landscape. Still today will become even more complicated, I guess. Let's look at how the UK can benefit. Nick, probably an area to start with you, please.
Yeah, I think this to me is a really exciting area, right? Because I think we're not going to, despite Julie's best efforts and everyone else, we are not going to end up with a simplified European or global structure with one global fund range distributed everywhere, which is clearly what makes most sense. You are going to end up with all these different fund ranges with different investors types and domiciles coming in. So technology is the bit that can bring that together, right? So we're doing lots around putting the same digital proposition on top of, regardless of what the fund domicile is. So the end investor, the distributor, gets the same experience. You in effect make it agnostic, even though it's not really agnostic. The investor goes in, they decide to invest with XYZ fund manager or through a platform or a wealth manager. They put in their tax status, residency, etc., and it will just direct you to the fund domicile. I don't think retail investors, even institutional investors, really care. Am I in a Lux fund, an Irish fund, a UK fund, an American fund, providing it works for them from a return and a tax perspective? So technology can make that agnostic. I think there is a point, there's a whole load of emerging technologies coming out there. It's incumbent on all of us to embrace them and drive it forward. And we've all got different views on blockchain versus Bitcoin and a whole load of different things. But what's clear is new technology is coming. We've got to embrace it. To me, the key is it's got to be in an open architecture, right? We've had multiple of these country by country initiatives. Everyone fails because the UK, you have 3 or 4 people trying to be the winner. And they all say, we're not going to have interoperability, we're all going to try and be the winner. Well, actually, no. That's not how the world is going to work. Let's have 5, 6, 7 different providers, provided they can all talk to each other and have interoperability. And then you can start going across domicile. And that, to me, becomes the utopian view. And that is what we as practitioners in the industry can resolve without being reliant on politicians and others.
Yeah, absolutely. And I was on a different industry event a couple of weeks back, and we spent a good sort of 3/4 of an hour just talking about some of the DLT and blockchain initiatives. So we won't be able to cover that right now. But Julie, what about your views on this?
Well, I mean, maybe just a couple of things. One is that KPMG does a sort of survey of chief execs around the globe once a year, and we issue something called CEO Outlook. And I'll just give you a couple of figures from that. 80% of CEOs said the pandemic had accelerated their digital transformation. Well, I think that's probably not a surprise. But 77%, so that's almost as much, said they're going to continue to build at that same pace on digital collaboration and communication skills and tools. So, I think, the pandemic, even when we've got through it in the vaccines, it's quite clear that this trend has just accelerated and isn't going to suddenly pull back. It's going to keep going rapidly, isn't it? And I suppose maybe the other thing to say is just to add maybe where the regulators appear to be coming back at it. And I say appear because I think there's clearly some mixed minds and mixed messages. Clearly, a number of them are saying, we recognise that technology advances is a good thing. We recognise the benefits and so on and so forth. But we as regulators are also concerned about how technology can heighten existing risks, like cyber, for example. So there's this sort of mixed mindset about it on the regulatory side. So and broadly, I think they are trying to cover it on all flanks as well, which means I'm not quite sure at the moment that there is one clear regulatory view of technology as a whole, if you see what I mean. So I think when they're thinking about the way in which technology is used to create products, deliver products, communicate with clients, improve outcomes with clients, that's one set of regulators, or within a regulator, that's one unit or team looking at it. Then you'll find another team that's sort of looking at how it's changing the underlying market infrastructure, like DLT and so on. And also those who are looking at how it's helping or not firms to run more efficiently, how it's changing the way we think about governance and controls, which up to now, we've really thought of them, although we may not have said so. If you look at any firm's governance controls, underlying presumption is everyone's sitting in the office together. So, compliance and internal audit come around and kick the tires by coming around to the offices and having a good damn look at what's going on, if you see what I mean. So the whole idea, just the whole government structure and controls need to be rethought in a largely remote working world. So there's that. And then also we've got the regulators themselves are sort of trying to get on the bandwagon. I mean, it's certainly they're trying to look at improving the way in which they communicate with regulated firms, which is both about how they get data submissions from firms, but how quickly they can react to it. But some of them are also trying to make their own processes more tech savvy, less dependent on us submit a form with a wet signature on it, allowing things to come through digitally with e-signatures and so on. So I think the key note is there is so much in this space that the regulators themselves, even within a regulator, are kind of pulled apart in different teams looking at different bits, perhaps not dissimilar to many firms. So the key question is, as Nick said, really, is how do you get this together to make it work?
Yeah, absolutely. And I think, we can break that down into, technology for distribution, technology for the onboarding, technology for compliance around e-signatures and things like that. I think, at its basis, this, again, back to the opportunity or threat, there must be an opportunity if we're going through a change to leverage some of this technology, hopefully, depending on what course we go on for the UK market specifically, I'd say. Okay, thank you. So I think in terms of another big theme, we've got the sustainable finance area. And, we have different jurisdictions claiming they're leading the way on that. I see a lot of activity in the UK market around ESG, in terms of from service providers, how we can help managers around that, governance around the benchmark, around actual ESG-led investments that are being brought to the market. So once we're outside of the EU's framework, what can the UK do more to ensure it captures the growth in that area? And Julie, we'll come to you for that one, please.
Okay, thank you. Well, I suppose we come back to a similar word, which is the whole question of interoperability that Nick introduced in the discussion on technology. The big challenges in these things are definitions, data, and documentation. And if you've got different definitions, you've got a problem before you've even started trying to collect and analyse the data consistently, and before you've even started to be able to make correct disclosures or decisions really about your strategies and actually what your real exposures are in the underlying portfolios. So those are the challenges we have to bear in mind. And I think I would say that in the area of corporate reporting, so, very much the sort of annual reports, interim statements and so on, where, the accountancy standard setting bodies, so the FRC in the UK and so on, they've been working together globally for quite some time to try to come up with similar definitions to move along the line of similar recommendations. Now it's still an evolving piece, but there is definitely quite a strong global cooperation in that area. I think it's when it comes to financial services regulation, a separate matter, which relates to the risks on the balance sheets of the firms themselves. So less of a concern in our sector, obviously, than in banks and insurers, but it's still there. But the other two big bits for our sector is, of course, the whole investment process and product governance processes, the whole process of how they incorporate ESG factors, and also then the whole disclosure side, both at company level and individual fund level, what you're doing. And first of all, I think it's just as a matter of fact that the EU is in the lead, probably globally, in terms of financial services regulation. Hard rules is definitely there on these other bits of the jigsaw. It's also there in the other kind of central bit, this taxonomy regulation. It is the first one that set out in financial services regulation what the definition of E is, environmentally sustainable, yeah? And they're going to move on to S. But that's there. So come back to the UK then. Well, look, all the deadlines, the first deadlines of all this legislation doesn't kick in. The very first one isn't until March of next year, after the transition period. So therefore, UK firms do not have to do this in the UK. That's the first statement. So what is going on? Well, in our experience, very many UK firms, because they're having to follow this stuff through their European operations, are going to effectively follow it in the UK market as well. Because if you're making a disclosure on a company website about your approach to investment, are you really going to have a different statement in the UK than you do in other parts of Europe? It doesn't seem to hang together well, does it? So that's one thing. And I suppose then, regulation aside, there's just commercial pressure. There's market pressure from investors, from institutions and individuals wanting more and more ESG funds. In the first quarter of this year, there were inflows to green funds when there were outflows from other funds in the dash to cash. Now we can have all sorts of questions about whether those funds are actually green or not, but the point is it's absolutely clear that the investor sentiment is there. So whether you have the regulation pushing you or the market is, money speaks, and if that's what the investors want, then that is what the sector will have to provide. But I suppose the last thing I should say again, in the Chancellor's speech on Monday, on the 9th of November, he mentioned that the UK would be drawing up its own green taxonomy. And I have to confess, at that point, my heart sank. Because if what we're trying to do around the globe is have some sort of consistent sort of definitions, whether it's the EU or the UN Social Development Goals, unless we begin to narrow the number of definitions, we will never get consistent data sets that can be used for any sort of analysis, whether it's by fund managers, asset managers, or indeed by the investors or banks or insurers. So this tension is a problem, I think, for the coming back to these big challenges of definitions, data, and documentation. We need consistency.
Yeah, absolutely, and I think UK can take a lead, even though we're not captured by that regulation, as you mentioned, come March next year. But it's about taking a lead, but keeping consistency, really. So, Nick, your views around this one, please.
Yeah, I think the two of you, firstly, I wouldn't doubt the investor sentiment about ethical investments, sustainable investments. To a degree, we could have been having the same discussion 10 years ago, and it probably hasn't moved on as much as all of us thought it would. So I'd agree with you on that one. But I have to say, you two are much more positive on European regulation than I am. So, just because the EU come up with a set of guidance or rules, I think probably at a stretch accept that's kind of world leading. But the fact that every country then adopts those rules differently kind of means you end up with multiple different regulations anyway. So I think actually, and then the UK, even when we're part of the EU, have different interpretations. So being outside the EU, I'm not sure it's going to make a blind bit of difference in that regard. As it comes to the UK, I think these type of investments are increasingly just moving towards providing the end investor with what they want, and the end investor needs the choice. And I think Julie picked up on an interesting point earlier about regulated funds or alternative funds. That end investor, be it a large institution or an individual, wants a balanced investment mandate. Now, if they can't get that through a regulated fund, they're going to go and talk to a platform or a wealth manager or a discretionary fund manager or an insurance company, and they're going to get that solution through that. And they're going to invest in the range of products they need to invest in. And, I think for us, whether Matt Adams decides to invest in a unit trust in OIC or put his millions with a wealth manager, we're going to service Matt Adams, and if he wants to interact digitally, that's fine. Equally, if he's a bit of a technophobe, God forbid, then we'll pick up the phone to him, or we'll accept his letter, or whatever. So I think it's just about being open to every channel and providing the solutions to the end investor. And I think that's probably the bit the regulators, despite all their protestations, forget. We're all here to service the end investor.
Yeah. Yeah, and we're in the service industry and all the delights that come with that, Nick, right? So great. Thanks again, Julie and Nick. We've covered quite a few areas there. I'd like to now transition to the Q&A section. We'll look for some questions to come through. There is a question field on the screen if people want to come forward with some questions.
Yeah, hi, I can see some questions coming through already. Let's start. So recently we've seen an increase in investment trusts, which is of course a uniquely UK structure. Do you think this demand will increase once we are outside of the EU? I've got some views on that one, but Julie, I know you've been doing some work with the IA extensively around the LTAF and other structures, as you mentioned. Is this something that's come up in that consultation, or you have a view of?
Well, it was part of the discussions in the group, an acknowledgement that those types of vehicles both exist and have existed longer. In fact, the unit trusts, the oldest investment trust, wrongly called, because really they're companies, as we know, the oldest ones are over a century old. So it's a very sound and long-standing sector. I think, though, in relation to, for example, the professional onshore fund, it's clear, although that we're saying they should be allowed to be listed to give that flexibility, I think we're clearly talking about the space where investors generally don't want listed products. It's the sort of the hedge fund space, the venture capital space, yeah. So they want something that's, if you like, a bit more private and not listed and generally, therefore constrained by any listing requirements. So that doesn't say that listed investment trusts won't continue to exist, not at all, and it's certainly clear. As to whether that sector will increase post-transition, I don't know, to be fully frank. It's a pretty sound sector. It's been around a long time. It's had growth. We don't know what will happen. It is true to say that authorised funds have a lot of extra regulatory requirements on them, which cost. So there is an issue in terms of the returns, because those costs effectively come off, the net return. But they are different beasts. Absolutely. And they've coexisted for so long, I don't quite see one taking over from the other, actually. I kind of see them as genuine options and well-used options for investors in the UK.
Yeah, I'd agree. And we see, or have seen actually, an increase in demand around existing providers of investment trusts going into sort of new and alternative type of investors under the investment trust structure. So quite a lot of demand in infrastructure investment trusts in the last, say, 12 to 18 months. I see that increasing, and we've actually seen some new entrants into that field. So people that haven't been, in that area for some time, and we've been a beneficiary of that, being one of the the largest administrators of investment trusts out there. So totally agree. I mean, there's also the liquidity issue we saw. In recent times, there's been plenty in the press around some of those challenges, and of course, investment trusts naturally help with that. Nick, any views from your side?
I think, as I said on the panel we had, Matt, I'm not sure I really understand the difference between an LTAF and an investment trust. So I'm don't mean to demean Julie's work in any way, but I kind of sort of question what's the difference, what's the point. I equally not sure I know if they'll grow or not. To me, it would make sense if they grew, especially in around savings plans, and when you see what's happening around child trust funds and converting out of them, and there's just huge volumes of work to do there, and we're doing lots of work of simplifying that digital journey, because otherwise we as an industry are going to lose those end investors, and we as a country are going to have even less people investing in their future than we've got now. So probably see some growth there, but I think the other thing I'd say on Julie's point is, if I'm honest, I'm not sure the man on the street really understands or cares if they're listed or not listed. I don't think they really understand what that means. I don't mean to demean my fellow countrymen, so I'm not sure that really matters.
Yeah.
I think they want the simplest way to invest, and I think we as an industry overcomplicate that. So,
and hence in the UK, the very large IFA network that's been out there, because people have been, in a way, they know what they get told. I guess the only thing I'd say around the listed is the importance of the broker network there. And I guess if you work in the industry, you're gonna very much understand that differential. If you don't, I totally agree with you, Nick. I think as long as you're more concerned about what the investment's in, and maybe the potential for the yield or growth that's going to provide, as opposed to understanding all of the details of the structure. Julie, any final comment on this one, particularly around that LTAF side, or we can move on to, we've just got another question, but I'll give you a minute maybe just to comment.
Well, just to say, the focus that there appears to be on the LTAF being a quiz, I think is very much a government decision, as far as I can tell. So that is the way it is. And that was the Chancellor's announcement. And I'm not privy to the very confidential discussions about how it came out that way, but that's the way it's come out at the moment. And I think it's about just kickstarting something. But I do think, otherwise, to be clear, financial advisors have used both listed investment trust and unlisted but authorised unit trust or OICs for decades, side by side.
Yes.
And you made, just to pick up your that on the liquidity point. I mean, yes, you have the liquidity management issues in open-ended funds, and some funds occasionally have to suspend or defer redemptions. Very, very few actually in the pandemic, in the high volatility of March. But equally, with the listed investment trust, what happens is the spread widens.
The price, yeah, absolutely.
The discount. So, it's 6 to 1.5 dozen the other in one sense. And as Nick kind of says, if you're either way, if you're a sophisticated investor or not, what you're looking at is what actually happens. What's the return at the end of the day?
Yeah, great, thank you. Just a reminder, if you would like to ask a question, you can do so in the bottom left-hand side of the screen there. If we don't get to any of the questions, we'll happily follow them up with you wherever possible. So another question here. Nick mentioned that technology helps with simplification, so investors can have the same experience everywhere. most asset managers and services seem to have very different processes and client experiences across jurisdictions. Do you think we will ever get there? Perhaps I'll come to you, Nick, for that one.
Yes.
And you are allowed to, you know, come away from the corporate tagline there if you.
No, I think I mean it's a spot on point that it's very different, and I think that plays to, you know, the challenge we have as an industry and, you know, across providers. But I think it is incumbent on ourselves, Matt, yourselves, probably everyone who's on this call, to kind of simplify that, and I think that's something we can do. I made a point on the panel also about, you know, we've got to work together, and I think this industry has been too focused on competing with each other in areas that don't really differentiate ourselves. And where we can build consistency, I think that's in everyone's best interest. So certainly it's right at the top of our agenda in terms of, you know, I think the big unknown with Brexit is that point you called out in your slides at the start, Matt, around cross-border investment. Nobody really knows where that goes, but I'm a believer in globalization and things coming together. And again, I don't think the investor should really care whether they're investing in an Irish fund, a UK fund, a French fund, whatever. It's what works for them. So we should be able to give them the same experience at the front end and the back end.
Yeah, I agree. And we need to break down this technology point around sort of different aspects because, you know, as we're seeing across the board, there's this growth in front to back technology enablers to make things more efficient, cheaper, more scalable. But when it comes to the actual end result, this is why we're seeing, I think, the influx of data as a service, because regardless of all of that back end technology, if we have a consistency around data, then, you know, we can pull those things out in a consistent way. And it relates a little bit to what we were talking about with ESG as well, because if we don't have a standardization there, all the technology in the world is not going to help. So, Julie, any comments from yourself on that one?
Well, I just suppose maybe kind of going back rather in history, given I'm long in the tooth. I mean, I was at the Bank of England when the bank ended up, a crack team had to end up taking over the whole issue of an equity settlement system. Because the industry had tried to do it as precisely as Nick said, there was, you know, the competing, interests, competing legacy systems. Everyone wanted to hang on to their own one and make everyone else adjust. And nothing was happening. And of course, in equities, the government quite rightly at that point realised that the equity market is a fundamental, and if it can't be settled properly, there's a systemic risk issue. So it just took over. Well, I don't think they're going to take over in our space. I mean, they've had some opportunities over the years and they haven't really had, but something else might take over, which is new technology, mightn't it? I mean, you know, if one of the issues is everyone's, as I say, hanging on to the way they're used to doing it, you know, and it's rather costly, understandably, to change, you know, unless you have to. Well, maybe new technologies will cause everyone to have to change.
Yeah.
You know, so maybe at last we will have a common, both a common ally, but maybe also a common enemy. But every player in the industry has to move. I think it's that point that we've never quite got to, and maybe it's not far off coming.
Yeah, it could be the catalyst for that. Absolutely agree. Okay, we do have another question come through. So Julie spoke about the long-term asset fund proposed by the Investment Association. Are there any other suggested structures that the panel thinks might be successful? Julie, I can't speak, obviously, for trade associations. That's not my job, but I do know that the Associated Real Estate Funds did put in a submission. I think, again, that was probably mainly around making the quiz work better for property funds. I may be doing them a disservice, but there's certainly, when I mentioned there's a number of players in the market, for example, I know Arif is there as well. But I think we do come to Nick's point about we shouldn't just keep complicating it. The professional onshore fund seems a very specific
investor and in area of the industry. It's the stuff that's offshore at the moment, and they want an unauthorised, unlisted vehicle. And we don't really have a tax-neutral version of that.
Yeah.
Okay, so that's that. The out of, as I say, is much more about the assets, and it's much more an economic imperative to help recovery. And also given the banking system simply can't fund infrastructure products in the way it used to, in fact, before the financial crisis of 2008. So there are very different dynamics as between those. We do have quite a wide range of vehicles. We also have unauthorised unit trusts that have been around for decades. So we almost have, we have too many. We do need to simplify, but the point is, investors do want different things, and it is absolutely clear that there is demand for an unauthorised, unlisted vehicle that works for professional investors, which would be attractive both for certain types of UK investors, but for overseas investors. So that goes to the competitive point for the UK.
I was going to say, because we haven't sort of touched around the corporation tax play, which has often been muted around the whole Brexit phenomenon, really. Nick, I'm conscious of time. Final thoughts from yourself?
Yeah, I think I mentioned before, I'd say liquidity funds. I'm surprised we don't have more as a domicile around liquidity, given there's so much liquidity floating around. And look, without wanting to overcomplicate it even more, it surprises me that ETFs, I know it's a little bit going back to the listed point, are not more on the radar as in the UK domicile perspective. And it's interesting, Julie's of course totally right, where I'm going to paraphrase you a little bit, Julie, but the government said this, so that's how it is. My leaving thought would be, well, that shouldn't be how it is, because if one thing's taught us anything over the last year, 5 years, 10 years, is politicians generally don't know what they're talking about. So we need to work with the industry and work with politicians, not be dictated by them.
Great, thanks, Nick. A controversial way to end the panel there, but I'd like to thank you both again very much for your time, and of course thank everyone for participation in this section of the webinar.